So the one that's most appropriate is FIFO, first in, first out, because that's assuming that the cheaper purchases have already been sold and the more expensive ones will be included in the balance of inventory at the end of the period. All right, question number 13. Why is the valuation of inventory important to managers? Right, well, there's a number of reasons why. First one is for performance reasons, because inventory, particularly closing inventory, is included in the calculation of the cost of goods sold. So it affects the gross profit and ultimately the net profit, and managers are accountable on their performance. So it can influence their figures and their bonuses. So, yep, that's why it is important to them. All right, number 17. Suppose you're a shareholder in a company and they switched their inventory from FIFO to weighted average. And as a result, the company's net profit dropped by 2 million. What would be your reaction? Well, one of the things that companies often do is they change their accounting policies from time to time. We can't stop them because you are allowed to do it. Under the accounting standards, you're permitted to choose whatever method of cost valuation you desire. And that includes FIFO, weighted average, specific identification, whatever. The only one you're not allowed to use is LIFO. And once a company has chosen one, they don't have to stick with it even. They can change to another one. The only thing that is required under the accounting standards is where you change from one method to another, whether it's inventory valuation or asset valuation or whatever it might be. If the effect is material on the profit, you need to show the reason and the effect of the change in accounting method. So, having said that, my reaction to that would be, okay, as long as they've shown the effect of it, I can see that the profit's gone down, but I can also see the impact by looking in the notes. So I can work it out whether the company is better or worse off than it was before. Because it's just by changing the method doesn't mean to say they've made more profit. It just means that it's been calculated differently. Obviously it could have implications on their debt covenants if they've got a loan, because the managers at the financial institutions would look at the bottom line and then see whether that has been contravened or not. The market would probably be savvy enough to work out that the resulting change has been reflected by a change in accounting policy, and they would incorporate that into the value of the shares. All right, the next one is problem 9.7. So this one is asking us to do some LIFO and FIFO, perpetual inventory, with the figures we've got there for a fortune teller, and we can do that, and then they want us to also apply net realisable value to the balance of the tarot cards that are left. So, firstly, with our COGS, under FIFO, we find that our cost of goods sold works out to be $1,590. Our closing inventory is 1,010. Under the perpetual method, it's a higher cost of goods sold but a lower inventory at 1,900 and 690. So we can see the impact of the change of methods. Now, with the NRV, obviously it's going to impact on our closing inventory. We had 130 items on hand at the end of the period, and if they're valued at only $5, the closing inventory would fall to 650. If we had adopted FIFO, the reduction would be 360, and with LIFO it's 40. Right, the next one was 9.8, which is another calculation of LIFO and FIFO and weighted average, working out the gross profit under each method, and then comparing the effects on the balance sheet and also the net profit in times of falling and rising prices. Okay, so they've done a bit of a table here, which is probably the easiest way to do it, particularly if you've got quite a few items in the purchases and sales. So we can see that under LIFO, right, we've got a cost of sales of 465 if we add those items up, and our ending inventory is going to be the aggregate of those items that we have there, which is 60. If we use FIFO, our cost of sales is $10 less at 455, but our inventory on hand is $10 more at $70. And then using the moving average or weighted average, the cost of sales is somewhere in between those two methods at 456, and the ending balance is $68, again in between the two other methods. So working out our gross profit under each method, you can see that there's a $10 difference between LIFO and FIFO because of the different cost of sales, and also a gross profit under the moving average in between those two methods. All right, the next one is asking us about specific identification method, where we identify the individual item of each item in the inventory on hand. It's not really a method that you would use for everyday goods. It's one that's very tedious and time-consuming to calculate, but it is applicable to certain industries. And as we said last time, maybe a jeweller or a car dealer would be perfect for that type of method. Question 4 talks about what happens in times of rising prices. And in times of rising prices, LIFO gives us a lower inventory valuation and a higher cost of sales, whereas in times of falling prices, it gives the opposite, higher inventory valuation and a higher profit figure than FIFO. All right, question 5. Accountants will depart from a cost-based valuation when we have a market or realisable value that's less than cost, and that's because of the accounting standard. It tells us that we need to value it at the lower of cost to net realisable value and write off any difference as an expense. We also have to write off any stock shortage. If there's an error or a theft, that needs to be adjusted. The next one that we've got was 9.14, and it asks us to calculate the inventory cost for some prints, X and Y. We use the FIFO basis, and we also need to use the average basis. So, based on the FIFO basis, the ending inventory works out to be 1,980, and our cost of goods sold under the average basis, it works out to be 18,885. So what we have is to calculate the ending inventory for Y print. So the market value is at $90. We have 28 units on hand, so it's a matter of multiplying 90 by 28, and that gives us 2,520. So that's the valuation under NRV. And if we compare that to our ending inventory up here, it's, that's for print X. Let's go to print Y. Ending inventory of print Y is going to be written down because the book value was higher than what the NRV is. Right, and the last question that we needed to address was an excerpt from the Sydney Morning Herald about Treasury Wine Estates. So Treasury Wine Estates is one of the world's largest winemakers, and they have offices in Australia and many other countries around the world. And one of the reports that appeared a few years ago was they had an oversupply of poor and unwanted wine. So they had too much wine on hand that was unsaleable or past its use-by date. So they had to write it down significantly to get rid of it, and also destroy some of the wine that was unsaleable. So what happened was the company's shares dropped 12%, and they lost their chief executive. So the question here is asking us, what is the journal entry for the write-down? Well, the journal entry is when we write something down, we expense it. So the expense is debited and the asset is credited. And then with the second part, when there was 35 million charge to destroy its past use-by date wines, again we have an expense of 35 million, and it depends on how that charge was paid. If it was paid by cash, it would go through the bank account, and if it was paid by credit, it would go to accounts payable, as we can see there in the solution. Right, number 2, why would the write-down lead to a decline in share price? Well, if you understand about the share market, it's efficient. And when the share market finds out information, it instantaneously takes that information into account in determining the share price. So in this case, when the market found out about the wines that were written down and also destroyed, they realised that that was going to have an effect on the company's bottom line, which would mean that they had less profit and they would probably give a smaller dividend. So that's why the share price went down. So the market would react based on the company's response to the situation. Because before that, they were probably unaware that they had an oversupply of wine, if it wasn't mentioned in the paper or anywhere else. So the first time that the market comes aware of public information, it acts accordingly. If the information is kept private, the market won't adjust because the investors don't know about it. Okay, any questions on those exercises? No? All right, well, let's have a look at the other practice exam question. All right, so this question was 8.1. Under what circumstances would each of the cost flow assumptions be appropriate? And then it asks you to apply them to that situation using FIFO and weighted average. That was one question. Another one here. Also had some purchases and opening inventory, and asked you to calculate the cost of ending inventory using FIFO, LIFO and weighted average, and then identify which costing method is not permitted, and obviously that's LIFO. The third one that has been posted was this one, which asks you to prepare the journal entries for the transactions A, B and C. That's this one here, the purchases, the sales and a return, and the stock adjustment. Right, so that was that. And then there was a net realisable value question, including GST. Right, and what else have we got here? All right, this is, again, valuing the inventory and cost of goods sold using FIFO and weighted average. All right, so I think we'll just go through a selection of these past exam questions. I'll choose the ones that are a little bit different to what we've done in the revision questions. So we'll do 8.1 number 1, right? So here we have the 4 methods, and we're asked to identify when we would use them. Well, we talked about this last week, when you would use specific identification, and we said for a house, a car, or a jeweller, I said, which isn't in that list there. The average cost would be where the goods are homogeneous or much the same and they're non-perishable, such as timber or wood, oil, raw materials, etc. LIFO is good for commodities like coal or sand or soil, the things that are just stuck in a big pile and you just take it as you want. And FIFO would be for perishable items. Okay, we won't go through the calculations because I think you know how to do them. We won't do that either. Right, so this one is the journal entries. I think I'll just quickly go through these. So when we have a purchase, the journal entry is to debit the inventory and credit accounts payable if they're bought on credit. When we have a sale, you debit the accounts receivable and credit the sales with the amount of money you received. And you also have to do the cost of goods sold and inventory. So it's a debit to the COGS and a credit to inventory. For the returns and allowances, we debit the return and credit the accounts receivable because the accounts receivable is going down and the sales are reducing. The returns obviously offset the sales. And then we also need to take into consideration the cost of those sales that have been returned because they're going back into inventory. So the inventory is going up, so we debit that. And the cost of goods sold is being reduced, so that gets credited. And then the last one was the stock loss. So this is a debit to the expense and a credit to inventory because that is being reduced. Right, and the next one was the adjustment for the stock write-down. It's simply debit the write-down and credit the inventory. Okay, I think that's about all we need to go through from that one. So let's close that down. Right, did anyone have any questions before we start today's topic? No? Okay. So as you can see, the topic for tonight is non-current assets. The areas that we'll be covering are property, plant and equipment, the cost of the asset, depreciation, impairment, disposal of the asset and intangibles. So we're covering a lot of ground tonight. So the things that will be, or the objectives that we'll be covering, these ones here. So hopefully by the end of this evening you'll be able to understand all of those points. But before we get into tonight's topic, let's look at the case study from last time. And the question that we posed last week was, after reading the case, we want to know why companies are allowed to use LIFO in the US and yet it's prohibited in countries like Australia. Right, what is the reason for that? Any idea? No? Anyone got any clue? Right, well there's a couple of reasons. The first one is that in the US they don't follow the international accounting standards, right? So whatever we do in Australia and what the international accounting standards say, they've said LIFO is prohibited. The US said, so what? We're using it, all right? Because they don't follow the international accounting standards. They follow their own standards. They follow a standard called the FASB. that does permit LIFO, whereas in Australia it's been prohibited for about 20 years. So why is it prohibited? Why did they ban it in Australia originally? What was the rationale behind it? Any idea? Well, I'll tell you a couple of things. When I went to university, it was permitted, right? That was many years ago. But since I started work, it was becoming a problem for the accounting authority. So over a period of time, probably about 10 years, they were recognising issues with it and problems. One, it was prohibited for tax. It's always been prohibited for tax because it gives a lower profit, and the taxman doesn't want low profits. He wants high profits, so he taxes you more. So it's always been prohibited for tax. And the accounting authorities were thinking that it was used more for a manipulative tool, and they really couldn't see the benefit of companies using it, particularly in times of rising prices. It was considered to be inappropriate because it gives a lower profit and a lower ending inventory. So yeah, they were the main reasons why it was banned, right? It just didn't add up. Right, let's look at the second one. From a financial reporting perspective, what are the possible reasons driving Armstrong Flooring, that was the case that we looked at last time, to switch from LIFO to FIFO? What was the reason why they did it? Remember, Armstrong Flooring was a US company and they changed their method of accounting for inventory. Well, if you read the case study, it said that they're permitted to change their basis of costing. Right? Every company can change their basis of costing, and Armstrong Flooring is no exception. Right? They were using LIFO, and they decided to change to FIFO. One, because they could. Right? There was no restriction on whether you use LIFO or FIFO in America. So both were acceptable. All they needed to do was show the impact of the change and the justification for the change, the effect of it. So they did that, and everything was fine. But their rationale behind it was, if we said that LIFO results in lower profits, FIFO results in higher profits. So because it gives them a higher profit, it makes it look like they're performing better. So that was the main reason why they did it, because the company was not performing all that well and they were looking at ways to improve their results. The other point mentioned there is their long production cycle, because of the flooring business. It was based on many months, and with FIFO it's more appropriate to match the costs with the revenues in times of rising prices. So that was another reason for it. And most other companies in their industry already use FIFO, so they can compare it against their peers more readily. Okay, let's get into the material for tonight. So the relevant accounting standards in the AASBs are 116 and in the international it's 16. So it talks about how we can account for our property, plant and equipment, when we need to write it down, when we need to apportion it for allocation over a period of time. How do we account for any profits on the sale of it? Right, all of these things are dealt with in the accounting standard. Generally speaking, the property, plant and equipment refers to tangible items. That means things we can touch and see, not intangible items, not things that are like goodwill or a brand or a trademark. Even though they are assets and they're non-current assets, they're not tangible, they're intangible. So that's dealt with under a different standard. The other thing that we also need to note is that these items are held for use in the production of goods and services, or for administrative purposes. They're not for buying and selling, right? We're not selling and buying the property, plant and equipment. That's not our line of business. And also, the property, plant and equipment is expected to be used for more than one accounting period. Why do we say that? Well, if it's only going to be used for one accounting period, then we might as well expense it, because it'll be used up and it'll be worthless at the end of the period, so we should just write it off at the start. And these are some examples of property, plant and equipment that we could have: land, buildings, machinery, motor vehicles, office equipment, computers. So under the accounting standard, there's 5 key issues that we need to address. The first one is, how do we arrive at the initial cost? How do we decide what value to put on our property, plant and equipment? In some cases it might be very straightforward. If we've bought it in a deal, it's the price that we pay. But it's not quite as simple as that. There's a lot of other things, that costs and expenses, that we need to decide how we're going to treat them. Do we write them off? Do we expense them? Do we ignore them? Whatever. So we'll come to that in due course. The second one is depreciation, which is a means of allocating the cost of the asset over a period of time. So it recognises the fact that the assets will wear out based on an assumption of their useful life, so they'll become less and less effective. So when that happens, it means that their value goes down, so we allocate an expense to that called depreciation. The third one is additional expenditure. So if along the way we might acquire future assets to add to the ones we already have, how do we deal with that? How do we account for that additional expenditure? Fourthly, we've got a change in value. So initially we value it at cost, and then we can change it. We can have the items assume a different value based under different circumstances, and we call this a revaluation. So we could change the value of a car, for example, or a building. If we choose to revalue it to fair value or market value, then we can, under the accounting standard. It allows us to do that. It also deals with impairment. And there is a separate standard on that as well, 136. And impairment is about the tests that we need to conduct on all assets, all non-current assets, to ensure that they're not overstated, because the key thing that we need to make sure of is that we haven't overvalued any asset in the books. And then it tells us what we should be doing when we dispose of our asset, whether we sell it, or do we just scrap it, or do we trade it or exchange it. The accounting standard will give us guidance. So let's go through the first issue, the initial cost. So it's very straightforward. The journal entry is to debit the asset, debit the GST relating to that asset, and then credit how we pay for it, whether by bank or accounts payable. So what could the cost be? Well, the cost could be the purchase price of the building, including any stamp duty and taxes. It doesn't include any discounts or rebates we may have. It also includes the transportation costs that we might have in bringing the asset to the condition necessary, ready for use. Also includes installation costs and assembly, and any fees that we might pay a professional to do that. It also includes the costs of dismantling or removing any existing asset in the place where the new asset is going to be located. So if we've got a new machine coming in, we might have to pay some money to get rid of the old machine. So that can be attributable to or capitalised as part of the cost of the new machine. So these are some examples of the initial cost. If we're constructing an office block, it will include not just the purchase price, but the stamp duty, conveyancing, legal fees. If we have to remove any walls, that could be part of the cost. Putting in new walls, upgrading the air conditioning, right? All of those things are costs of acquisition. If we're constructing the office building, then it would include these costs: the demolition, the architect's fees, excavation, labour, materials, setting up some security during the construction, because these days you have to have a security around the workplace to make it safe, depreciation on that equipment, and if we borrowed money for the construction, then any interest on the loan we can capitalise whilst we're constructing. If we acquired a new computer system, it would include the actual purchase price of that computer, as well as the delivery, the insurance, whilst it's in transportation from one location to the other, the installation costs, and testing the equipment and training the staff to be able to use it. All of that is part of the new system. All right, so we now have a task for you people to consider, and this is a new machine that you have got possession of. You know that the invoice price is $240,000 including GST. Delivery charge is $1,600, also including GST. Installation is $2,600 with GST. You've got labour setup costs $4,250, and you've got some insurance that you're paying at $3,200, including GST. So we want you to work out the cost of the machine and then do some journal entries to record that acquisition. All right, I'll give you about 10 minutes to work it out. I hope you've brought your calculators, because you will need to, especially with working out the GST. Has everybody ticked their name off yet? You haven't asked? All right, have we got a cost for the machine yet? Anyone? Surely someone's finished. I can't remember whether that's correct or not, but we'll find out in just a moment. We're going to look at the answer now. Right, so the cost of the machine. First of all, we have to take out the GST from the invoice price. So it brings it down to 218,181. We do the same with the delivery charge and the installation materials. And we add in the in-house labour, which didn't have GST because we're paying the wages. So I don't think that was the figure you had, was it? Ah, I see. No, we have to exclude GST. We have to exclude. Did anyone include the insurance? No? Well, that's good. You didn't fall for that trap. Okay, so the journal entry would be to debit the plant and machinery with this amount here, 226,250. Debit the GST, which was 22,200. And credit the accounts payable for the total amount that we paid, which was 244,200. Then we also have to credit the bank, presumably we paid for the labour. And then finally we have the insurance, which we expense. We don't include that as part of the cost because it's something that will get the benefit over 12 months. So it cost us 3,200. We take out the GST of 291, So the actual expense is 2909. Okay, any questions on that one? No? Right, so just to reinforce, you have to always separate the GST from the cost, because when we put it in the books, it's at cost excluding GST. Okay? All right, next thing we're going to talk about is depreciation. So what is depreciation? Well, depreciation is an arbitrary allocation of an asset over its useful life. How do we determine the useful life? Well, it's based on similar assets, it's based on our judgment, it's based on, it might be based on information that we have about the item from the manufacturer to tell us how long it should last. Right? All of those things are used as a guidance to determine what the useful life might be. So we recognise that the benefits of this particular asset is going to be consumed over time, and that will be continuous. So if we look at a machine, for example, and say we purchased it a decade ago, then we realise that now the benefit of that machine is a lot less than it was when it was originally purchased. It's probably slowing down, it's probably resulting in more stops and repairs and so forth, and it's not as efficient as it used to be. And what's more, it might only have a few more years left. So the value of the machine is obviously diminished, so we need to recognise that, and we do that through this concept of depreciation. Now, something that we don't, or an asset that we don't apply depreciation to is land, because we recognise that the value of land is infinite. Once you've bought the land, it's going to stay there forever and ever. If there's a fire or a flood, the land will still be there. So over time, it will appreciate rather than depreciate. So just to reinforce the concept of depreciation, it's a process of allocation, not a revaluing. Right? It's nothing to do with revaluing the item, it's just allocating its cost over its useful life. And the reason why we do it is for the matching principle, where we match our costs against the revenues that the machine might be generating. So we could use a play on words and say that it's reflecting changes in the value of use rather than the value in exchange. Now, there's all sorts of different depreciation methods we could employ, many in the marketplace. We're only going to talk about a few tonight, some of the more common ones. But regardless of which method we do choose, ultimately, as the owners or the accountants, we need to make judgments on the useful life, as I said earlier. How do we determine what that might be? We also have to come up with a figure for the residual value. What is this item going to be worth at the end of its days? Can we sell it? Can we get any money for it? Or is it worthless? Thirdly, we need to consider how we're going to generate the benefits. Are they going to be even over the useful life, or are they going to be greater at the beginning and less at the end, or the other way around? Because that can influence the method we choose as well. So the methods that we're going to consider here tonight are only three: straight line, reducing balance, and units of production. But as I said, there's dozens more. These are three of the more common and probably the easier methods to understand. The most common, of course, is the straight line method, and that's the easiest of all, and the reason why it's the most popular is that it's very simple to apply and very easy to understand. But it doesn't matter which method we use, the journal entry is always going to be the same, and that is debit depreciation expense and credit accumulated depreciation. So what sort of account is accumulated depreciation? Well, it is considered to be a contra asset, or if you like, you can call it a negative asset. It's there to offset the value of the asset in the balance sheet. And it shows the total amount of depreciation to date over the asset's life. So we can call this expression cost less accumulated depreciation, carrying amount, book value, written down value. They're all expressions that we can associate with this phrase, and they all mean exactly the same thing. So that's how it is expressed, like so. We have the asset, in this case plant and equipment, at 1.5 million, and the accumulated depreciation is 90,000. That is subtracted, giving us the carrying amount or book value or written down value at 1.41 million. Okay, let's now go through each of those methods, starting with straight line. So straight line is all about an even consumption over time. So we depreciate the same amount whether it's year 1, 2, 3, 4 or the last year of the asset's life. And we assume that the pattern of benefits will flow the same. So the way we calculate our depreciation expense is to take the cost, what we paid for that asset, less the residual value, if there is any, and divide it by the useful life. So applying this to an example, let's say we've got a delivery van that we paid 40 grand for. We're saying that it's going to last us for 5 years. At the end of that time, it's going to be worth 5 grand. So let's work out our depreciation expense. So based on this method, we take the 40,000, subtract the 5 and divide it by 5. So that gives us 35,000 over 5, which works out to be 7,000 per annum. And it also means that our accumulated depreciation starts at 7,000 after the first year, increases to 14 after 2 years, and after 3 years it's already 21,000. So the carrying amount will be the difference between the original cost and subtracting the accumulated depreciation. So 40 minus 7 is 33. 40 minus 14 is 26. 40 minus 21 is 19. So that's how it works. Okay, let's turn our attention to the second method, reducing balance. Now for this method, there is a technical way in which we can arrive at the amount, but it involves doing square roots and so forth, and because not everybody is comfortable in doing that, and they might not have a calculator to let them do that, They give you the formula in the book, but we don't usually use the formula. We just give you the rate and then you just apply the rate. So the whole premise of this method is that it assumes the benefits are going to be greater in the early years and less in the later years. So what I'm talking about, this rate here is usually not given and you have to work it out, but if you want to refer to your book, it'll show you how to do that. For this subject, we don't make it too difficult, we give you the rate. So it's a matter of taking the cost, subtracting the accumulated depreciation and then multiplying it by the given rate, and we ignore the residual. So in this case, let's say we've got the same example and our rate is 25%. So in the first year, we're going to be depreciating it by 10,000, which is a quarter of 40. And our carrying amount will be the difference, which is 30. In year 2, we now depreciate 30, which is the carrying amount. Multiply that by 25% and we get 7,500. That's our new depreciation for year 2. So our carrying amount is, if we take that away from 30, we get 22.5. So that's the new carrying amount at the end of year 2. And finally, for year 3, we take 22.5, multiply that by a quarter, or divide it by a quarter, whatever you like, and that gives us depreciation of 5,625. Take that away from 22.5 and we get 16,875. Does everyone follow how that's done? You're shaking your head like that. Does that mean you understand it? Good. All right. So in comparing the two methods that we've looked at to date, we can see that the straight line can be represented like so, and that's why it's called straight line, whereas reducing balance is on a sloping curve. That's the expense. The carrying amount is like this, going down, and the reducing balance, it goes down like a parabola. Okay, you can do this, but I think we'll have a break first before we get you to do this, or if you want to do it during your break, you can do that as well. So it's just on 6:15, so let's say we resume in about 10 minutes time, all right? It'll give you time to get a drink or whatever else you might want to do. Who has the attendance? Is it finished? Everyone tick themselves off now? No one yet to do it? Okay, great. You have it.
这个其实没问题，问题出现在 credit 这块儿，因为这个事业，约你看的738这个玩意儿的，然后就是说明我那个 debit 是对的，但是对，就是因为这个 credit 可能差了一点。这个就是其实简单来说，但是这个简单是就是属于什么好的资料，那它就是说明气死我了。
How are we going? Are we almost finished with this one? Yeah? All right, I'll give you a couple more minutes and then we'll go through it. All right, let's go through this one now. So, under the straight line, it's pretty easy. It's 44,000. And we need to do the adjustment for the GST. So we divide that by 11. So that brings the cost of the machine down to 40,000. Subtract the residual, which was 8,000. So that brings it down to 32 over 4 years, so it's 8,000 per annum. Did we all get that? Yep, fine. So the accumulated depreciation is going to be 8, 16, 24 and 32,000. So at the end of year 4, it's going to be worth just the residual, which is $8,000. Right, moving on to the next method, reducing balance. So we take the 40,000, which was the cost, multiply that by a third, so we get 13,280. That's our depreciation expense for year 1. We then take that off the 40,000 and again multiply it by that rate and we get 8871. So we then add that to the previous years, brings it up to 22. We do the same thing for the next year 3, take that 22 away from the 40, multiply it by the same rate and we get 5926. Add that to the 22,151 to give us 28,077. Again, we take that away from the cost and multiply it by our depreciation rate to give us 3958. So then the sum after 4 years is 32,035. So our carrying amount using this method is going to be 7965. So it works out much the same as the other. Over the asset's useful life, it'll change. Of course, this method has a greater amount in the early years and less in the latter years. So for the first 2 years, you've got more than the straight line method, and then in the last 2 years, you've got a lot less. But over a period of time, the total amount of depreciation is going to be the same, roughly, 32,000 under both methods. And the carrying amount at the end of the useful life will be the residual, give or take a few dollars for rounding. So it works out to be around $8,000. All right, let's look at the third and final method, which is called the units of production. So this method varies according to the amount of consumption that an asset uses over time. And we recognise that that consumption can vary. Sometimes it will be a lot, sometimes it will be little. For example, if it's a machine, some years it might be a lot if the machine's been working overtime. Other times it might be little if it's been out of action due to repairs or a major overhaul. So the formula that we use under this method, we take the cost minus the residual and divide it by the estimated units of activity. And then multiply it by the actual units for that particular period. So applying it to a machine, in this case we've got a machine that we paid $18,000 for. It has a residual of $3,000 and the useful life is in hours, not years, 12,000 hours. So they ask us to calculate the expense based on the operating time. So for the first year, we have to apportion 4,000. In the second year, another 2,500. And then we have to calculate the carrying amount at the end of the second year. All right, that's your task. So I'll give you 5 minutes to sort it out. All right, I think you should have finished the answer to that by now. It's not all that difficult. So we take the value of the asset, 18, minus the scrap value of 3, gives us 15,000. And the actual useful life is 12,000 hours. So in terms of rating the cost to an hour, it works out to be $1.25. So you can do it that way and then multiply it by the number of hours, which gives you 5,000. So that's one way of doing it. There are other ways you can work out and you get the same answer. The second year, it's 2,500 hours. So that equates to $3,125. So at the end of year 2, the accumulated depreciation is going to be 8,125, and our carrying amount will be 9,875. Did you all get that? Yep, great. All right, let's now look at our next aspect, and this is the additional expenditure after acquisition. So if we have an asset, and it doesn't matter what the asset is, sometimes we spend more money on that asset, whether it's a truck or a factory or a machine, and these acquisitions or additional expenditure can be capitalised in some cases, because effectively they're making the asset more useful. They're improving the worth of the asset. So, for example, if it's just maintaining the asset's value, such as regular maintenance, that's not increasing the value. So that wouldn't constitute additional expenditure that would be capitalised. We only capitalise expenditure that's going to increase the useful life, or it's going to increase the productive capacity, or increase the residual value. Otherwise, we just write it off as repairs and maintenance. So if we contrast these two examples here, if it's a major overhaul, and let's say it's a car, right, and we've changed the engine and we've put in a new chassis and increased the boot size and all sorts of alterations, it's going to make that motor vehicle a lot more useful than it was previously. So consequently, we would capitalise it. But if we're just doing an annual tune-up and replacing the spark plugs and replacing the oil and doing a few other things, then we're not going to capitalise it. We're going to write it off. Next thing we're going to look at is the disposal of a property, plant and equipment. So if we have an asset that may be sold, or it might be disposed upon, or it might be of no further economic benefit, in other words, it's exhausted all its usefulness, then we have to write it out of the books. So the way in which we can do that, firstly, we have to update our depreciation up to the date of sale. So depreciation we normally charge annually, and the sale could occur at any time during the year. So if it occurs during the year, then we obviously need to apportion our depreciation up to that date. and we will calculate the gain or loss on the sale by comparing that book value with the proceeds that we receive. And then we record the sale in the books on the date that it occurred. So the journal entry looks something like this. We will credit the asset to take it out of the books. We will debit our accumulated depreciation to take that out of the books. We will credit the proceeds, whether it's by cash or other means, and depending on whether that gives rise to a gain or a loss, will determine whether we debit or credit the balance. So if it's a loss, it's going to be debited. If it's a gain, it will be credited. All right, so let's have a look at an example. We've got an industrial refrigerator that we purchased some time ago in July 2011 for 1.32 million, including GST. The asset has a residual of 75,000 and it's expected to last for 10 years. The company has a policy that they will depreciate on a straight line basis. The machine is going to be sold for 400,000 on the 30th of June 2016. So they ask us to prepare a journal entry to record the purchase of that machine and the first year's depreciation. And then secondly, record the journal entry at the date of sale. Right, so remember, we're selling it 5 years after we bought it, right? 5 years after we bought it. So there's a fair amount of depreciation that we need to update. So after having done that, we can then compare the book value to the sale price of 400,000, work out whether it's more or less. That will determine whether we've got a gain or a loss. And then we do our journal entry. Okay, so I'll give you about 5 minutes to go through that one. Don't forget to take out the GST. Just give you another minute, folks, and then we'll go through the solution. All right, let's go through it now. So the first thing that we need to do is to work out the amount of the machine. So if we divide the 1.32 million by 11, we find out that the GST is 120,000 and the cost of the machine is 1.2 million. So that's recording the initial purchase, which they paid for cash. The end of the first year, we've got depreciation, which is based on the cost minus the scrap, divided by 10, and that works out to be 112,500, which will be the same amount that will be depreciated for each of the years in the asset's life. And we credit accumulated depreciation, of course. So then, at the end of the 2016 year, when the asset was sold, some 5 years later, we've had 5 years of depreciation. So 5 times 112,500 works out to be 562,500. And we only got 400,000 for it. So the value of the machine is a lot more than that. So we had a massive loss on sale of 237,500. Okay, the next topic that we're going to tackle is revaluation. Now, under the accounting standards, we can revalue some of our non-current assets using 2 bases. There's the cost method and the revaluation method. The revaluation method is based on fair value, which a definition of fair value is the amount that you could exchange between 2 willing but not over anxious buyers and sellers in an arm's length transaction. So we're assuming that the 2 parties are prepared to engage in a sale, and we're also assuming that they're fairly knowledgeable and they're not known to each other. So that will determine the market value or the value of the asset, and you can revalue some of your non-current assets to a new amount if you think the value is under what the real value might be. For example, if you had a block of land that you purchased, say, 50 years ago at cost for $10,000, and today it might be worth $2 million. So if you leave it in the books at $10,000, it's not going to be all that realistic. So we have the opportunity of revaluing it by virtue of the accounting standard, and that's what we can do. So we're not going into too much detail about it because it is covered in another accounting unit. I think it's MAA 716, if any of you happen to do that next term. But the revaluation is only optional. You don't have to do it. And once you applied the revaluation model, you need to review it regularly. And any increase or decrease needs to be adjusted in the accounts. So if it's a reduction in the value of the asset, then we take it through the comprehensive income statement as an expense or a reduction. And if it's an increase, it goes to the revaluation surplus. Right, let's have a look at an example. We're revaluing land in this case. The land cost us 1 million and we're going to revalue it to 1.7 million. So the journal entry will be to increase the value of the land by debiting it and then crediting the gain or the revaluation surplus, with the difference being 700,000. Now, if we had an item that wasn't land, and for example it was a building that had depreciation on it, the first thing we must do is write back that depreciation, and then after we've written back the depreciation, then we do our revaluation. Right, let's look at another scenario. Let's say that in the next year the land was written down by 100,000. We've done another revaluation and now it's worth 1.6 million. So this time we have to reverse it. So we debit the loss on revaluation and credit the land. And that then gets adjusted against the revaluation surplus. Now, the reason why we do it that way is because in the first instance here, we created a reserve. This account here is part of our equity. So when the asset goes down, we're effectively reducing this reserve. So the reserve has been reduced to 600,000. Then if the asset goes up again, we then add to this and increase it. And if it goes down, then we reduce it. But let's say what happens if the asset went down, first of all. So if the first instance was a reduction, then it would be written off to the comprehensive income statement as an expense. And then if it went up again, we would offset that amount by putting it through as a gain to the comprehensive income statement to the extent that we had written off as an expense in that statement. But we won't go into too much detail in that. We're just giving you a little bit of a taste for it because you will be dealing with it in another accounting unit if you choose to do more accounting. Right, the next thing that we're going to tackle tonight is impairment. Excuse me. Okay, the accounting standard for impairment is 136, and that standard requires all entities to assess their non-current assets at the end of each reporting period to see if the value has diminished. Now, this process is not like the revaluation. This is mandatory, right? Mandatory. It's not optional. You need to make sure that you have tested your assets periodically for impairment. Now, one of the things that we need to look at when we're testing them The accounting standard says we examine the carrying amount, which is the book value, and check that against the recoverable amount to see if it exceeds it. If the carrying amount is greater than the recoverable amount, then a loss needs to be recognised. If it's the other way around, we can leave it as it is. So we know what the carrying amount is, we've already defined that. But the recoverable amount we haven't spoken of yet, and this is defined as the higher of the fair value, which we've talked about what a fair value is, the amount that you can exchange in an orderly market, less any costs of sale. So that's one aspect of it, and the other one is called the value in use. So the value in use is worked out as the present value of future cash flows expected to be derived from the asset. So in order to work that out, we obviously need to have a discount rate. So we choose a discount rate, and we also have to work out what our estimated future cash flows might be, discount them to the present, and that becomes our value in use. So we compare those two, fair value and value in use, whichever is the higher, becomes the recoverable amount that we're going to use to test against the carrying amount. And the journal entry that we need to process is to debit impairment expense or impairment loss and credit accumulated impairment. So some of the things that could indicate that impairment is imminent might be a decline in the market value of the asset, might be a change in technology to make the asset obsolete, change in market conditions, change in the economy, or new legal constraints that might diminish the value of the asset. Or there could be physical damage, or the asset's performance has declined much more than any depreciation could involve. Let's have a look at an application of this. So let's assume that we have a motor vehicle and it cost us $30,000. The accumulated depreciation to date is 5. We're assuming the fair value is 18 and the value in use is 16,500. Now again, with the value in use, we're going to give you that figure. We're not going to expect you to do the discounting and the present value calculations. We do that in another unit. So here we're just giving you a little bit of a taste for it. This topic is also dealt with in that other unit that I was talking to you about, 716. So it's like an introduction to this topic. So we want you to do two things: determine what the impairment loss is going to be and do the journal entry, and then do an extract from the balance sheet. I'll give you 5 minutes to go through it. All right, let's work it out. Did anyone come up with an amount of the loss yet? Sounds pretty good. Right, so our carrying amount works out to be 25 grand. And if we take the higher of the fair value and the value in use, it is the 18. And we then compare the 25 with the 18. And of course, that means that the loss is 7. So we debit impairment loss and credit accumulated impairment. That's part A. Part B is the balance sheet extract. So we have our motor vehicle at cost, less the accumulated depreciation and any impairment losses, which in this case is the 5 plus the 7, which comes to 12. So the written down value is 18. All right, let's move on to our next topic, which is intangible assets. So intangible assets are covered by the accounting standard 138, and they're defined as ones that are non-monetary and without physical substance. They can be identifiable or they can be unidentifiable, depending on which ones we're talking about. But one of the key characteristics is that they cannot be separately sold, transferred or exchanged from the asset that they're attached to. So let's say it's a goodwill, right? We can't sell the goodwill without selling the business. Who's going to buy goodwill or custom or whatever it might be if they're not going to have the business to apply it to? It's not worth anything. So that's the first characteristics. There is separability. Secondly, we know that it creates value in the financial statements. So this can be recognised if it's purchased. If we pay money for it, we can recognise it. However, if it's internally generated, in other words, we just think that we've worked the business really hard and consequently we need to reward our hard work by increasing the value of our business and creating an internally generated goodwill or whatever we might want to call it. Under the Australian accounting standards, that is not permitted to be recognised as an asset. In America, you can, under their accounting standards, because they've got a completely different set of rules. Right, another characteristic is that it's non-monetary. In other words, if it's a monetary asset, it can be exchanged for a determined amount of money, for example, inventory or receivables, but intangibles create opportunities, but they don't give us any contractual right to receive money. We also note that it is without physical substance, so you can't touch it or move it. It is intangible. And it doesn't have those assets under the conceptual framework which we are guided by. We can only demonstrate the existence of them by observation. For example, mining rights is an intangible asset. So how do we apply the mining rights? We apply it to a particular area of land and we can then start mining for whatever we want to do. There's some examples of intangibles. We've got patents, copyrights, trademarks, brand names, franchises and goodwill. And another one that we've got on the list there is R&D, or research and development. So mining companies, chemical companies, a lot of companies will engage in research and development, and if it is qualified, right, it's not a cut and dried case, all research and development is treated as an intangible asset, but some of it, depending on the criteria, and I'm not going to give you a lecture on that because that's a separate topic on its own. But if it qualifies and it's relating to future economic benefit, then it too can be deemed to be an asset and you can treat it as such. Right, let's now look at the measurement of these intangibles. How do we measure them? Well, if they're internally generated, as we said, you don't include them. All right, internally generated are not included. But there is an exception, right? The exception is development expenditure and exploration and evaluation costs. They are exceptions and we can capitalise those, again, if it meets the certain tests under that particular standard. Some research costs need to be expensed, so they don't get carried forward. If it's an externally acquired intangible and it's a separate acquisition, then it's likely to satisfy all the recognition tests. So once it's done that, then we can recognise it at cost. And in that case, it will be adding all those costs that we talked about before, the purchase price, any tax, and any other associated costs associated with it. If it's purchased through a combination of businesses, again, that's going to be covered in another accounting unit. So once we've recorded the intangible at cost, we need to recognise it in the books. And we recognise it initially at cost, but then we have a choice. Again, we can choose whether we adopt the cost model or the revaluation model, but we can only do a revaluation if the market is deemed to be active. In other words, there's buyers and sellers around, so we can get a fair value on the item. In some items, it's quite uncommon for an active market to occur. For example, if it's a brand name, there may not be a lot of people in the market for a brand name, so their market is usually not active. Or if it's a something that's quite unusual, that is unique, there may not be an active market for that either. But some intangibles do have an active market. For example, franchises. Buying a franchise for McDonald's, for example. There's an active market for that. Or buying a licence to fish. There's an active market for that. Or buying a taxi licence. Again, an active market. We also need to determine whether the asset has a limited life or an indefinite life. If it's a brand name, then the life will be limited based on how long we've registered that brand name for. We might register it for 7 years. So after 7 years, someone else can use that brand name. So we would write that cost of the brand name off over 7 years. However, if it's an indefinite life, then we can decide what the apportionment of the write-off might be, and obviously test it for impairment at regular intervals to make sure that it's not overvalued. Now, when we write off, let's say we're writing off the brand name, instead of doing like what we did before with other non-current assets and depreciating it, we call it a different name, but it's essentially working in the same manner, and it's called amortisation. So we amortise the intangibles by writing them off over a period of years, especially if they've got a limited useful life. If they've got an indefinite life, then we shouldn't amortise them, but rather just test them annually for impairment. So the example of that would be goodwill, right? Goodwill usually has an indefinite life, so we only test that for impairment. We don't amortise it. We used to. 10 years ago, we used to amortise goodwill, but the authorities have changed their tune and they've introduced impairment instead. So we just test it for impairment now. We don't amortise it. All right, the next thing we're going to look at is goodwill, which is one of the key intangible items that we need to deal with. As we said earlier, if it's internally generated, we can't record it as an asset in Australia. But if it's been purchased, in other words, we've paid money from another company for the business, which includes goodwill, then whatever the goodwill is, we record it in the books. So the way in which we value this purchased goodwill, it's the amount that we pay to the vendor for their business, or portion of the business, depending on how much we have acquired, less the fair value of the net assets, whatever that might be. So, what are some of the reasons why we might have goodwill? The first one is because of the location. The location might be extremely good where the business is being run. It might be the management are very competent and they're adding value to the business. It might be the customers that are associated with the business. Might be the future cash flows that are expected to be generated. It might be the market's reputation, or it might be the intellectual capacity of the people. Let's have a look at an example of purchase goodwill. So let's say the football club Manchester United's net assets are $2 billion, and one of the competing clubs, Manchester City, decides to buy it. And they pay $2.5 billion for the privilege. So obviously the difference is $500 million. So that is shown as goodwill in the books of the purchaser. And that would be purchase goodwill, which is legitimately an intangible asset, and we would test it annually for impairment. And in our balance sheet, we show it as a non-current asset. We also have some arguments as to why we can't recognise internally generated intangibles. And these are some of the arguments based on the various accounting concepts. So if we look at our conceptual framework, it tells us that assets and other elements need to be faithfully representative. So is internally generated intangibles capable of faithful representation? Well, probably not, because it's very difficult to determine a value for them if there's no active market. The assumptions that we have to rely upon are also very questionable. But there's another competing argument, and that is the argument of inconsistency. If we don't recognise it, and we recognise purchase goodwill or purchased intangibles, that's not being totally consistent. It seems to be a little bit out of step. Why do we recognise some assets and not others? We could also argue that it's more relevant if we include it. And it's going to result in an understatement of our assets. It's also being ultra-conservative, and it will result in a disparity between the book value and the market value. All right, you guys have a task now on intangibles. Firstly, we have to discuss the accounting treatment of each of these items. First one is customer base being increased by 20% during the financial year. Should we recognise it? If so, how? And how do we subsequently measure it? Secondly, Kim acquired a patent for a cash of $500,000. It means that the patent is valid for 15 years, but the company is only going to hold it for 12. And then the third one is a brand that was purchased for cash for $3 million, and the company estimates that the future benefits will be generated indefinitely. Okay, I'll give you 5 minutes to consider each of those scenarios. All right, let's have a look at the treatment that we should do for each of these ones. So the first one is the customer base. Well, it's very vague. We haven't got a value for it, and it's something that we would include in our goodwill, but as we said, if it hasn't been purchased and it's customers that we have acquired and generated, then it's internally generated, so no transaction should be recognised. And it can't be reliably measured. So it's not applicable to measure it. Looking at the next one, the patent, that is a different scenario. This should be recognised as an asset because we've paid $500,000 for it and it was externally acquired. But there's no active market for it, so we can't revalue it. We just need to treat it at cost and then periodically test it for impairment and do some amortisation over the asset's life, because we're going to use it for 12 years. They estimate that it's useful for 15, but we have to take the lesser of the two, which in this case is 12, and amortise it over that period. There could be impairment, so we need to test it for that as well. The last one is the brand name, which we acquired for $3 million. That's externally acquired and separable, so therefore we can recognise it as an asset. But just like the second one, no active market, no upward valuation, and we don't have a useful life. It's unlimited, so we can't amortise it. But we can test it for impairment. All right, let's look at our case study for next time. So this is another excerpt from our newspaper, and it's about ASIC revealing its role in Channel 9's $260 million write-down. All right, they wrote down $260 million worth of goodwill in the network because of impairment. It goes on to say that they figured that the value of the goodwill was diminishing, and of course that meant that the shares were worth less, so they traded down. Right, so they go on to say that it was caused by the loss in advertising revenue and online ads and social media that triggered their write-down. However, we need to consider, why did Nine Entertainment require to impair the network by $260 million? Right? What was their motivation for it? So we're going to talk about that next time. So in the meantime, you can get the full article at that address there, and we'll discuss it next week. These are the questions that I'd also like you to have a crack at next time. We've got a few questions out of Trotman, a couple of problems, and also some past exam questions which have been also published under the resources. And next week we're going to be looking at liabilities, chapter 11 in your textbook. Okay, any questions before we close? No? All right, well, here's some, as a footnote, some market value versus book value of companies in 2014. Right, some of the biggest companies in Australia. There's their market capitalisation, which is worked out at the share price times the number of shares. So you can see that CBA is slightly ahead of BHP in the market capitalisation, but in the book value of their assets, BHP is the greatest Australian. All right, that's it for today, folks. So we'll see you next week when we talk about liabilities.